Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on MartinRea Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Hi, John. Great to be with you. It's been obviously a number of months since we've spoken and gotten caught up. But of course, we've been speaking for years now. And I do want to remind our viewers, because we don't always say this on TV, but you've been in the investment business since 1983, your own firm since 1993. So obviously that's a lot of experience that we get to hear about from your perspective. So why don't we kind of just start there in terms of the macro view? Obviously, there's a lot of concern right now in terms of which way the market goes. We've had a huge run so far this year, and now we maybe have some stumbling blocks in terms of that higher interest rate environment or inflation that we might be facing and putting some downward pressure on the market. So kind of top-down perspective, where do you stand these days, John?
We're probably more positive than I've been in a while, Catherine. I mean, notwithstanding the move we've seen in the past year and the risk, I think we've reset the cycle effectively. I mean, the downturn we saw last year at the beginning of the pandemic, where you saw the market fall 35% in less than a month, and the economy was down 2 quarters in a row, one being the worst since the 1930s, has effectively sort of reset the cycle, much as we did in sort of the early 1980s, and again in 1990, and again following the financial crisis. And I think now you've got a few more tailwinds at your back that's going to give you better growth for the next number of years. Certainly the monetary stimulus we've seen out there from central banks globally, particularly from the US. And on top of that, what we're seeing from the fiscal stimulus in the US, which is making this more a US-led global recovery, reminiscent of sort of the 80s and 90s, and different from the post-financial crisis, which was led by a massive fiscal stimulus from China, which did a lot of spending within their own economy. That sort of drove the commodities market, drove a global recovery, but also drove their debt levels pretty significantly higher, and they aren't able to probably dominate the recovery this time around. But the U.S. is clearly pulling out all the stops. They're doing the mass vaccinations there better than anybody. And I think that the economy recovers more quickly with tailwinds, like I say, from monetary stimulus. Fed Chair Powell has gone out to pains to say they are going to stay out of the way of markets. I mean, in 2018, as you recall, that market downturned significantly in the fourth quarter because he was talking about normalizing interest rates and all his. I don't know whether he's learned his lesson or something else is different, but he is going to pains to the other extreme right now, saying they're not even thinking about raising rates till 1922 or 2022, 2023 probably. Whether the market believes it or not is another story. And they've even let inflation run a little bit higher for a period of time if they had to, just to get it back in place. So I mean, between that massive monetary stimulus and the fiscal stimulus, we are like resetting for a new cycle, which means it's probably a pretty good time to invest. More so in maybe cyclical stocks that have some earnings economic sensitivity, as opposed to the stocks that have dominated in the past year. And we're going to get your bumps along the way, much you did coming out of any cycle. We saw that in the early 80s, in the early 90s, again into the 2010. You'll get some pullbacks along the way. We might be closer to that now. I'm not, I don't want to sort of invest on the basis of the day-to-day moves. I think if investors ask, is it a good time to generally be invested in equities for the next number of years? I'd say absolutely yes. Because on top of that, the alternatives still aren't going to look good for a while. I mean, the 40-year bull market in bonds, Catherine, in my view, is over. Interest rates probably stay low for a while, so the alternatives don't look that attractive. Well-priced stocks with decent dividends, good place to be.
Okay, so a lot to go through there for sure. I want to, pick up on a point though that you mentioned, which is really interesting. We think about the market really since the 2008 financial crisis and keeping interest rates lower for longer, but we sometimes forget that it really was China that stimulated their economy, that really helped carry the rest of us along, with a lack of stimulus from Europe, a fiscal stimulus that is from Europe, the United States and Canada as well. So it's interesting to point out that, maybe now it will in fact be the US's turn to do just that. And I guess the question will be, will it be even more effective, even more beneficial to global growth? But as we think about, and I love the fact that you're likening it to the 1980s and 1990s, in terms of what that might mean in terms of, broader economic participation for more people than we've seen over the past 10 years. But having said that, when you take a look at the market movements over the past couple of days, I think people have been concerned that the fiscal stimulus out of the United States will come at what cost? How do we get there? And the concern, of course, is that they'll increase taxes. I mean, they've kind of been pretty clear about that. And if that's the case, what does that really mean in terms of corporate spending? And will corporations in the United States go back to offshoring, relocating? What will it mean for individual spending? So where does that fall into that entire dynamic?
Yeah, I mean, on the tax side, you have to pay the piper at some point effectively. So yeah, I mean, there probably are going to be some tax increases along the way. That's probably, more of a political consideration in the U.S. as to, exactly how you fund that. I mean, for now, it's really interesting when you think of it, Catherine. I mean, they're effectively what we call, monetizing the debt. I mean, the U.S. Federal Reserve is standing there buying up bonds, this quantitative easing that they're buying basically, what, $120 billion a month. But the U.S. Treasury, if you notice, has been doing auctions this month north of 200 billion. So effectively, the Treasury's selling all this debt, and the Fed is buying it all up, sticking it on their balance sheet. That can't go on indefinitely. At some point, you probably depreciate the currency. So, it's an interesting way to play it. And you've got all these monetary theorists out there saying that doesn't matter. You're not creating inflation. You never will again. And I don't know if I buy that. It's probably the argument why you'd want to stick a little bit of money in gold or, Bitcoin or whatever, some store of value outside just in case. But you're right. It's got to be paid for. These debts have to be reckoned with at some point in time. And the debt we've run up in the current prices globally is astronomical. But as everyone says, the cost of servicing it with interest rates near zero is manageable for now. But it also means that the global economy and the U.S. economy could not absorb a substantial increase in interest rates. So, it's not happening to any large degree. I mean, the market, the bond market's telling you it's tightening up a little bit, but let's face it. I mean, we're getting all worked up about U.S. Treasuries at 1.5 or 1.6%. I mean, historically, that's nowhere. I mean, historically, when you look at it, 10-year yields used to be at the nominal growth rate of the economy. I mean, real growth plus inflation, which you could call right now, if you get, 2.5% inflation this year and, 6% real growth, I would say 8%.
Yeah.
U.S. Treasuries are not going to 8% anytime soon. I can guarantee you that. So.
Do you know, John, it was interesting. I was reading a Goldman note this morning, actually, and they were talking about going back to the 1300s, if you can believe it, looking at the impact on inflation of wars versus pandemics, and that it's very different. With wars, you have the destruction of capital, obviously, and a strain on resources, where sadly with pandemics, you have a loss of life. And it's the governments that fill in the gaps. And that's obviously what we're seeing in terms of, the stimulus checks, et cetera. But wars do lead to inflation, whereas historically it looks like pandemics do not. And it might, in fact, just be transitory, as the US Federal Reserve continues to tell us. Do you buy into that? I mean, where do you see the interest rates moving? And you're right. I mean, we're at such low levels, and that's, many strategists' commentary. We're at such low levels. If we're up by 50 basis points, 60 basis points, what difference does it really make? Do you agree with that? Or is there a breaking point in your mind in terms of, an overheating of the economy? Because that is what people are concerned about.
I guess I would agree to it more than I would have thought in the past, especially given some of the robust growth we saw a couple of years ago as well, and into the late teens. And yet you didn't, ignite any inflationary pressures. But you're right, Catherine. I mean, the longer term impact, deflationary pressures are going to remain, which is sort of global outsourcing effectively, and technology. Technology will continue to drive down costs of business, of transactions, and everything else in general. and that flowed through more than, the price of, oil or any other copper or any other specific commodity rising. Their impact on the economy is not what it used to be. And you're absolutely right too. I mean, wars were inflationary. I mean, coming out of the World War II to some degree, certainly coming out of the Vietnam War, that was, some of the worst inflation you saw. I mean, the oil prices went at the same time, so you put the two of them together. But it's also why, as you say, on the pandemic related, people are sort of talking about, the roaring 20s as opposed to, similar to a century ago. I don't know if I completely buy that, but that was the period post-pandemic. But it was also post-World War One as well, where you had massive reparations and repayments. So I mean, there's a lot of factors that play here. I think the biggest factors that play for us today going forward are, I think, the impact of technology on costs in general. I mean, that is so massive. And it's been demonstrated, Catherine, to us in such a way in the past year. Let's face it, I mean, who would have guessed a year ago that businesses, and look at what we're doing right now, would run as smoothly, as efficiently as they have, given the massive shutdown of the economy that we've seen. I think you have to be impressed. Networks held up, businesses held up, despite the fact that nobody is doing, what they were a year and a half ago in terms of how they do business, how they meet people, fly to places and things like that.
Yeah.
Adjusted, and that's really got to be thank technology for that. So.
It's true. And, even just being able to do TV interviews like you and I have done over the past 10 years, my costs are very minimal sitting here. My light, the camera, etc. Very, very different. So, and again, that those costs are driven down dramatically, to your point, because of technology, to the point where there are some people, John, you and I know them, some veterans in the fixed income industry, who believe that, we are in a deflationary world. We will not see real moves higher in inflation. And that matters. We'll talk about, kind of more where you're investing now. That matters because, do you still want to own dividend stocks? Will you still be rewarded if you do? Because, if rates really rise, your dividend stocks don't appreciate as much. So, and there could even be some risk. So taken all together, it sounds as though the backdrop for investing, to your point, from a longer term perspective is certainly positive. You've got the fiscal stimulus, not too much fear of inflation. But we do have to be a bit tactical, it feels like right now, unless you're really just truly a buy and hold. And you do also run a hedge fund, so people should know that you know how to be tactical. Not everybody does. It's a whole nother skill set, that's for sure. So talk to us a little bit about how you're strategizing on a day-to-day, in terms of your different approaches.
Well, you're right, Catherine, about, the dividends. It would be at risk a little bit, dividend paying stocks, if rates were to rise significantly. But yeah, I don't see that at all. And I look at, the telecom sector, the banking sector, pipeline, where you got 6-7% dividend yields right now. Rates aren't going to rise that much, and they have no ability to at this. And you would have, have such a negative impact on the economy, you'd be quickly unwinding that again. So I don't think that's going to happen. I think the inflation is transitory, as we said. It'll pop up for a while, but I think, the longer term costs are still coming down. So that's all a positive backdrop for the markets overall. You'd mentioned earlier too, Catherine, about corporations and, debt and what they, what they'll do. I find it interesting, particularly in Canada, when you look at the past week, corporations are joining in. They become a little bit more bullish. I mean, corporations always hold back on capital spending and other things when the future is uncertain. But what we've talked about resetting the cycle, I think the future is a little bit more certain. And I mean, just look in Canada in the past couple of, 2 weeks in particular, Rogers going out basically, $25 billion to buy Shaw. CP Rail, $25 billion plus to buy Kansas City Southern, and to amalgamate that network for a national basis. These companies that wouldn't be, and they're both mostly cash deals. I don't think these companies would be making those sorts of expenditures if they were sort of thinking we were late in the cycle, there were higher risks of rates. So I think it's a good indication that we're sort of in a pretty good place at this point in time. So like I say, it just goes more to the idea that, I think investors, if they don't get caught chasing the wrong names, we can talk about that in picks a little bit, don't get caught up in the greed and the enthusiasm and maybe read too much about what you think everybody else is doing, because that's where the risks are. And you can get caught up and lose a lot of money in a hurry there on that side. And that's where I'd wave some caution flags.
Yeah. It's interesting to point out those merger deals that took place in Canada, because you're right. I mean, I think we were so focused on the actual deal rather than what the deal's telling us, which is, you know, deals of those size, especially here in Canada, are pretty massive. It is a really bullish sign. Do you think, just as an aside, do you think that the Rogers Shaw deal goes through?
I mean, the market's sort of saying right now it's probably only, probably a 60% probability given where Shaw's price and all that. And you know yourself, I mean, in the telecom sector, the regulators are always trying to get into the middle of it. So, I mean, it's a tough road to hoe, but I think the consolidation in that sector probably continues, and there's not a lot of players left. So you can understand why Rogers lined up to want to buy Shaw, create the national network. I mean, some of these assets are disappearing quickly. And it's actually, interestingly, it's a similar story with CP buying Kansas City. When you look at it, if you're trying to patchwork together sort of a North American network that fits in with, the new NAFTA, there weren't many players you could sort of go out there and buy. And this is CP's third kick at the can of trying to do a deal like this. So this one probably has a better chance of success. Yeah, both those deals are going to face some regulatory risk. Every deal does. But like I said, what I like about it, Catherine, is the fact that these guys are putting cash out. I always get concerned when companies start doing deals based on stock, which we saw in the tech sector sort of in the late 90s. We saw even in, the cannabis sector a few years ago, when companies, if you had a company and you thought your stock was massively overvalued, what would you do? Well, you'd probably do a takeover using the stock. And when companies are paying cash, to me, it says no, they just want to do this deal for the accretion they can get from it, as opposed to the idea that their stock is inflated. So
Hmm. Interesting. That the cash is a positive sign for you.
absolutely, yeah.
Oh, okay. John, let's take a few questions, and then we'll get to your number one top idea, your hold idea, and then also what you'd be selling today.
Sure.
This is from Kevin. He's asking, how frothy is the market still? It seems with bond yields and the growth of money moving out of tech, the reopening trade is getting more interest, but there still seems to be an addiction to the freely printed money. And at what point does the reckoning come and fundamentals support investment decisions? Does he see a large correction coming? Generally, I'm an optimist, but just wondering what the tea leaves are saying. I'm a novice investor and learn a lot from these interviews. Lot there in that question. What do we
Well,
think?
it's an interesting question too, because I absolutely think that this is very similar to sort of coming out of the tech bubble in 1999, 2000, and what happened afterwards. I think because of the growth of what we call the passive money that's gone into indexes, in particular in the past couple of years, you've seen the values, the Amazons, the Apples, the Microsoft, a lot of money is just flooded into those names, driven up the valuations. And I think there's either risk that if money moves elsewhere, these things are going to turn down. They are the biggest part of the market right now. I mean, the FANG stocks alone are about 25% of the index in the US. So if they start to roll over, your indices can come down, but the average stock, other areas, that are less invested in can do well. And that's what you saw in sort of 2001. And when you saw the market turn down, I mean, the big tech stocks, which were such a big part of the index, remember Nortel was what, 35% of the TSX. It ended up dropping 80%. Well, that alone is going to take the market down, 30% right there. But a lot of, the metals, the energy, the industrials, they can drop nearly as much. I think you're getting to that similar stage here. There's a lot of fairly valued pockets of the market that I think could easily live through a downturn of the averages. So maybe it's probably a better time for stock selection as opposed to maybe index investing. And I think there are those areas that are frothy and they will roll over. And some of them already have. I mean, look at it. The hot stocks of the past year. I mean, Tesla, and we could talk about that one forever, but it's actually down about 25% from its peak. Zoom is down over 40% from its peak. I mean, don't even get me started on GameStop. I mean, some of these things where there's no valuation support at all, but that those pockets can collapse very quickly, and I think that's where the danger is. Because investors get caught up, and you're sort of the last guy in, and then you suddenly turn around, and boy, you're down 40%. That's the sort of things I remember coming out of 2008, where people come to you and said, I've had to change my whole retirement plans and everything else because I'm suddenly down 40 or 45%. You don't want to be taking those risks. And I think in a lot of parts of the market, you're not, but in some areas that have done very well, you have to watch out. So your call that came in or question about
Yeah.
froth, yeah, there absolutely are areas of froth, but I don't think it's in the entire market.
Right. And just to pick up on that, it seems as though we really have been in a stock picker's market for a solid year, maybe year and a half or so, versus just sometimes it's great to own the ETFs that represent, sectors or subsectors, but there are some real opportunities if you own some certain stocks. But John, I do want to pick up on one aspect that you brought up that I think about actually almost every day because I own some of these stocks, which is when you look at the tech companies of the 2000 era and the tech boom and bust. I mean, if you didn't get out of some of those names, they were down, to your point, 50, 60, 70% for 10 years and or longer. But everybody says maybe it's different this time with some of the big bellwethers, like a Facebook, a Google, an Amazon, an Apple. Those, I think, are almost those staple core tech names in so many people's portfolios. What kind of risk do you see in any of those names or not? Can we actually own these as like you would own consumer staple companies 30 years ago?
Well, I see a little more of your latter point there, less risk, because I think there's a different dynamic going on there, which is consolidation to the larger players. I mean, we're all moving to fewer platforms. I mean, basically you're either Android or iOS on the wireless devices on networks and all of that. So you're consolidating. I mean, Microsoft that are really dominating the cloud, or Microsoft, Amazon, effectively together, Alphabet to degree dominating the cloud completely. So you got fewer players, and they're sort of gobbling up all the smaller guys along the way. And they're generating cash too, which is different than it was in the 90s. You remember that. I mean, they weren't fundamentally sound companies back then. They weren't generating cash. They were, they had eyeballs and things like that. So I think it's a different story from that point of view. But Catherine, the point you make that I think is really important to pay attention to is that the difference between a good company and a good stock, and sometimes these things can get well ahead of themselves. And you're right. I mean, Microsoft peaked in 2000, and it took basically almost 15 years for it to get back to that price. And it's not like the business collapsed. If you look at Microsoft between 2000 and 2015, I mean, they grew very well. It's not like the industry fell apart, but stocks get well ahead of their valuations. And I think when you look at a Zoom or Peloton or a Tesla or a lot of those similar kinds of companies, I think they're well ahead of fundamentals, and it could take years to grow into those. And we get reminded of this all the time. I mean, you only have to go back about 2.5 years to this is the big run in the pot stocks and all of that, when everybody loved them and they were working out so well to realize, hey, that can end in a heartbeat. And once this flood of new money disappears, then valuations have to support them, and the valuations don't support them, forget about it. So I think those are important things investors always have to be thinking about, these good companies with good solid stories at reasonable prices. And I think the big tech companies, to a degree are. I mean, 30 times earnings for Apple, Microsoft, that's certainly rich. It's going to take a little while to grow into that. But they're generating lots of cash and will continue to dominate those industries.
Yeah, no, that's a great point. And Microsoft was certainly top of mind. I mean, my goodness, it did nothing for so long as a stock, but the company was great or fine. So, it's you always have to know what you're paying for and be okay with it and really believe in the growth rate. And also, of course, if there's going to be money behind it supporting the stock price. I mean, money flow matters. John, let's take another question. This is from Bob. Could you ask John about CVS and WEF?
In terms of CVS, I like the pharmaceutical retailing area because they're almost becoming a play on healthcare effectively, because what they're doing within the shop, let's face it, right up here, I mean, that's why I like Loblaws, is what they've done with Shoppers Drug Mart the past year. I mean, let's face it, you go in there now and you're just not going in there buying supplies. I mean, you're getting your vaccines there, you're doing so much else. And I think, as retailers, they're positioned a little bit more, so whether it's Walgreens or CVS or whatever, I think they're very positioned well in the retailing world for some continued growth at the right multiple. So I'm comfortable with it. It's not the top name I'd be going after. Healthcare is a tough field sometimes as well because of regulation, but it's certainly got demographics on its side, and it should get continued growth there. So.
Okay. And sorry, just to pick up on that, Loblaws you like because of what they're doing with shoppers. You just think there's going to be some nice synergies and it's a go-to destination almost?
Yeah, I like what they've done there. Absolutely. I just think, that acquisition made a lot of sense for them. It fits in very well. You can do the cross selling. And I just think, in the retailing world, I think, that healthcare is going through the pharmaceutical sector, and it's just, pharmaceutical industry, and on the retailing side, yeah, that's becoming more of a go-to for many people. So.
Hmm. Okay. Let's take a question from Martin in Calgary. He says, hello, Catherine, could you please ask John about Magna? Does he think that supply chain issues will create a headwind, and should I take some profit?
Yeah, you can take profits in the short term a little bit, maybe, because you're right. The first quarter is going to be a little soft for these guys just because of, the chip shortage, and that's hit the auto industry harder than it's hit anybody. But I wouldn't want to get too cute on that one, because I like the parts manufacturers and I like the auto companies. I think there's a lot of growth going forward, and the parts manufacturers are very well positioned. Particularly names like Magna up here and MartinRea in terms of the lightweighting of vehicles, and they're also very well positioned for the movement into EV, into electronic vehicles as well. And they can, shift some of their manufacturing around. They're generating cash, and the valuations. We're talking about companies trading at 3 to 4 times operating cash flow, 9 to 10 times earnings. I mean, you can do that in an industry where you still got some growth and cyclicality. I think it's good. So yeah, we own Magna, and yeah, it's had a pretty healthy run, and you sort of get tempted to take some profits. Maybe we shave position back a little bit, but I'm leaving the position on and keeping it for long term. And a few of those names fit in as my best of the old GARP, growth at a reasonable price kind of parameter, and I think the auto stocks in general and the parts companies fit into
Okay.
that
And
group as well.
there's also a question of Martin Is that one that you own or would look to own?
Yeah, that's probably even a bigger position than Magna. It's corrected a fair bit recently. Again, they're going to struggle a little in its first quarter because of the chip shortage. But again, these guys are big into the lightweighting of vehicles, aluminum parts. I can see them positioning more of the electric vehicles as well. And valuation is exceptionally cheap. Like I say, about 3 times operating cash flow and 9 to 10 times earnings. So it's pretty attractive.
Interesting. Okay. And Darren is asking if you think deglobalization will occur and how large will the effect be on inflation and corporate profits. This is something, when we think about deglobalization, that was really more under a Trump presidency. At the same time, though, as well, we are hearing Buy America from President Biden. So we're hoping it's going to be Buy North America. But what are your thoughts these days on deglobalization?
It is, what it is, it's sort of struck. You had this growth curve of globalization since the early 1980s, and you can just see it. And when you look at now global trade in the past couple of years, you're right, whether with the prior administration in the U.S. or some other, sort of nationalistic views in some administrations are causing, the problems with China and the U.S. and other things, causing some maybe hiccups in this. But I still think the whole idea of the reasons for globalization make so much sense. I mean, let's face it, it's the old economic theory of how do you grow the entire pie at the greatest rate is if everybody focuses on the thing where they have the best competitive advantage. And that's what globalization gives you. It gives you manufacturing in the right countries. It gives you research and development in the countries that can do these things most effectively. So it's hard for me to believe that globalization is going to start to reverse. Maybe the growth of it slows down a little because you've got some, more nationalistic governments in a few places. We saw it in the U.S. We've seen it, certainly in China more recently, and even in some European economies, with obviously with Brexit and other things, they're all closing the doors a little bit more. And I think it's been amplified a little bit in the pandemic just because of the vaccine issues. I mean, that's probably even brought it to the forefront as more of a problem because everybody sort of got the vaccine hoarding a little bit. We're not going to distribute it until we've, treated our own population first. But in the end, the reasons for globalization, I think, remain in place. The trend may just not be the same pace it was in the 80s and 90s and past couple of decades.
Do you see the risk in terms of some of the geopolitical tensions as of the past couple of days surrounding China, with the UK, US, Canada imposing sanctions on Chinese officials because of human rights abuses? I mean, how do you think about that?
Well, economics are clashing with politics a little on that basis. I would say, Catherine, because you certainly, I mean, the growth of the Chinese economy, and it's still a communist regime there effectively, even though it's got capitalistic sort of tendencies. It clashes with what you see, in the other largest economies of the world. So it's there's a lot of things to be smoothed out there, and globalization and sharing of technology is probably again highlighting those differences. So those problems or issues aren't going to go away. I think they're decades going forward, but I don't think they're going to undermine global growth in general, because in the end, all these countries sort of have the same objective. I mean, they want full employment. They want to grow their economy. They want the people to do well. They want the companies to do well. I mean, so they're trying to achieve the same end. So there are sort of cross purposes. It's not an either or sort of zero sum game where we gain only if you lose kind of thing, which was, I hate to say, that was maybe a little was painted more so in the last U.S. administration, but I don't think that's the view that's necessarily the right global view going forward. So.
Do you own any of the Chinese tech companies? I'm just curious. They've been under a little bit of pressure rebounding today. From a longer term perspective, do you like them?
I don't have them in the portfolio, Catherine. I guess it's hard for me to know as much about them. I mean, in the tech world, I can know more about what Amazon, Microsoft, I've used their products. I know them more effectively. I know what their markets are and the regulation. And I even understand the accounting. I don't as much on the Chinese companies. So, I'm happy to invest in companies that can benefit from the growth of China. We certainly got on the commodity producers and others. And but for the other players, it's a little bit different. So I don't, answer your question, no, I don't have any direct investments in Alibaba or Tencent or any of those players directly right now.
And speaking of tech, we've got a question from Yannick on BlackBerry. What's your view on BlackBerry right now?
We sold it. I mean, I like the story. I think John Chen's done an amazing job. But when you had that meme kind of run up earlier in the year, we got lucky. We sold the thing in the low 20s, but I was shaking my head. I mean, it was just a ridiculous run up in some of these names based on obviously, the Reddit sort of chatter that drove up the names of the companies that were most shorted and took them to valuations that were just not sustainable. So I mean, their earnings are coming out, I think, next week. So it'll be interesting to see. I like say what John Chen has done is a great turnaround there. But we got out, and I probably wouldn't be a buyer again unless I saw a price sort of maybe down, the $7-8 US range or something like that. Like I still think what they do with QNX, what they're going to do in cybersecurity is decent growth, but again, it's what are you willing to pay for that? And when it traded north of $20 up here, that was more than enough for me.
Right. We've got another question here. A couple of items in this question, and it is from John. He's asking, what are Mr. Zechner's thoughts on the likelihood of the Federal Reserve implementing some sort of yield curve control despite their insistence otherwise? He's also curious to know what he thinks would happen to the various reflationary, deflationary sectors, so financials, tech in particular, which thrive on higher and lower long-term yields respectively, if in fact the Fed does extend the maturity of their asset purchases. Does the market ignore or look through the distortion of the bond market, or does it accept the distorted yields and therefore inflation expectations and the repricing of these sectors accordingly?
Well, I think the reality for the Fed is they can't really control the entire yield curve, much as they like to say they can. I mean, they will get swamped by the amount of bond buying they would ultimately have to do to support that. It just it can't be done. It's just it's like you remember the old new issues if the underwriter had to go to support them. I mean, that all that was the shorts would wake up, but they were going to short into this, but eventually, they can't hold up those walls on their own. What the Fed can do is control the short end of the curve, and that's what they're doing. They're keeping your short rates effectively zero. markets are going to determine the longer end of the curve, and that's why you're seeing, the treasury yields go a little bit higher. In terms of who that impacts, the banks, it's great for them, which is why you've seen the financials rally, and I think the financials will rally more. I think the financial stocks here and in the U.S. are undervalued, and they're going to benefit from this yield curve steepening a little bit because, as you know, they tend to borrow short, lend long. I think as the economy starts to recover, you realize what the bank's balance sheet is, what they've mostly been doing for the past couple of years, because they haven't had much ability to grow or increase their lending. They've been putting the money back into treasuries. And again, so I think they'll stop doing that, which is, again, you lose one more buyer for bonds, but then they'll start to loan money out again. And which is, again, we talked about these mergers you saw in the past week. I mean, both of them were done with obviously massive loan packages from central bank, from the charter banks. So I think more of that will come in, and that will benefit their growth going forward. So yeah, we've added to the financial stocks in both Canada and the U.S. recently. I like them, and they position well from recovering economy. Probably over provided for loan losses in the downturn last year. And the fact that it's interesting, there's so many programs out to sort of for the individuals in both countries that you haven't had, the bankruptcy, the downturns that you normally would have. So the bank, set up for loan losses, but they haven't really realized these loan losses yet. So maybe they take some of that money that they've reserved, they take it back into earnings at some point too. Those are all tailwinds for, the banks going forward. So I like the financials on that basis. So I mean,
yeah. Last question here, and it does pick up on what you're talking about in terms of the mergers. It's from David in North Bay. He's saying, has the pandemic escalated more mergers than during normal economic times?
They were restricting in some industries. I mean, I'd say most companies probably held back on mergers for a while. I mean, for a lot of companies, that was a touchy-feely kind of thing where they had to get on an airplane and go and see the businesses and all of that. I don't think they were, sort of set up to negotiate deals over Zoom. So, I mean, that slowed it down a little bit. And clearly, some were restricted from doing it. The regulated industry, particularly financials, wouldn't have been able to go out and do acquisitions. I think those are loosening up, which is why you're starting to see some deal flow start to happen again right now. So yeah, I think it's been impacted negatively, but that, like I say, that should start to change.
Dave is also asking a question about the auto sector, which is going to lead into your top pick for new money today. He is asking your thoughts on the emerging electric vehicle market, and in particular, Volkswagen versus Tesla.
Yeah, I mean, I think obviously all the companies are now talking about the idea that, by 2030 or whatever, a bulk of their production is going to be electrical vehicles. I mean, I think these timelines sometimes move a little bit slower than they expect, but that's where we're going. I mean, there seems no doubt about it, from an environmental point of view, but that's where all the money is going into as well in terms of production going forward and everything else. The infrastructure has to be set up a little bit more. But obviously the battery power is improving. So you look at the majors, and you're right. Volkswagen, I mean, they have a brand. They also have auto production experience. So I think these guys can all migrate to electrical vehicles very effectively, and that is going to be a headwind for Tesla, who everyone views as sort of owning this industry. And I think they're not going to own this industry. They may dominate it for a while, but they're going to be facing a lot more competition, and they're not going to have the benefit of all the credits they've been receiving. I mean, let's face it, on a pure profits basis, if they weren't getting the credits back, they wouldn't even be profitable for the past couple of years.
So that brings us to your top pick, John, in terms of the automotive sector. Your top pick is?
I would take General Motors, and I just think it's, like I say, it's sort of a simple thesis. I mean, General Motors with a 70 billion market cap, and Tesla had been as high as 800 billion. So more than 10 times the value, and yet GM probably makes 6 to 8 times as many automobiles in a year. So I mean, that alone sort of sticks out. But I think GM, when I look at the model, Hummer or other things they're going to bring out, they will be a presence in the EV market. They can use the cash flow from an existing sort of combustion vehicle to fund some of that. They have the ability and proven ability in the past to be manufacturers. They have the brand name. So I think on the valuation basis, yeah, you talk about that at 10 or 12 times earnings and 5 times operating cash flow versus the huge valuation of a Tesla. I think yeah, this thing sticks out. I mean, in the hedge fund, if I had more guts, I'd probably maybe short one and go long the other. But shorting individual stocks is just at your own risk kind of thing. Lately, I just haven't been doing it. It's just you can end up wearing those positions in a very ugly way. But I think just getting long GM on the other side is to me a very safe bet and probably a good area. Growing, the valuation is cheap, and I think they'll position themselves well in a growth industry.
So John, it's interesting. So new money to work, you can, for our viewers, put it into GM. The valuation, it goes back to what we were talking about earlier in terms of how important valuation is as it relates to stock picking. You think it's attractive, obviously, but you're also really kind of taking a look at it in the EV market and being a very fair or fierce competitor to Tesla, which is highly debated.
Yeah, no, you're right. I mean, the purists in the industry, you listen to the Kathy Woods or someone like that, and they'll talk about Tesla in a whole different genre. But I mean, then they're talking about the battery power, what they're doing on SpaceX and other things like that. I think yeah, as a technology company, I'll give them credit. Tesla probably has much more going for it. But in the pure area of auto production and ability to migrate over to electrical vehicles, I don't know. I mean, I don't have a problem going with a company that's been a proven in that industry for over 100 years versus a company that has been around for less than 2 decades kind of thing. So yeah, Tesla is certainly winning that in the near term, but I think these other companies can't be ignored. And the market is pricing as if Tesla will basically own this industry, and I don't believe that will be true.
Well, and it's important to pick up, and I think it doesn't get talked about much. But your point about Tesla's profitability, if they didn't get the credits, let's describe what those credits are.
Well, just the rebates for anybody who buys an electric vehicle. I mean, that will probably go across, and you're still going to see it for carbon credits for other things, just from an environmental point of view. But that won't be limited just to Tesla. And as the electrical vehicle market grows, I mean, these subsidies will not be able to keep pace to the same degree. It's different when you're producing 100 or 200,000 vehicles a year. They have those credits in place from the point of view of the governments that have to finance those. You start to get 4, 5, 6 million vehicles a year on that same basis. I think they have to look a little more closely at the cost. So yeah, ultimately, these companies have to be able to justify the production and the cost and everything else on a standalone basis without credits.
Mm-hmm. Right. The subsidization of some of these industries, when we get kind of all thinking about the future and the prospects, we kind of forget some of these areas are subsidized. And if there's going to be more units that have to be subsidized, at what point can't the government fund that? Fair?
Yeah,
is that fair?
The question is how much money they're willing to do, especially if they are running profitable operations. I mean, it's sort of, you look at it, it's going to be silly at some point to provide those subsidies, unless it's directly to the consumer somehow, to the companies that are generating profits and have, market caps of $1 trillion. So
yeah, the balance here.
yeah, exactly.
Yeah, let's talk about some areas that you're really comfortable to hold right now.
I think the dividend players. I mean, there's companies that are growing that are reasonable valuations that just pay out a good yield. So I look at the telecom sector where the yields are probably 6% plus. Some of the pipeline companies, 7-8% dividend yields. The financials, 5% plus dividend yields. Valuations are reasonable. So it's just an area where you say you're going to get a better return than you're going to get in certainly from cash, or you're not going to get in the bond market anymore. So I think you have to have things like this as a ballast in your portfolio. You got to have some area. Some people will want some growth in higher growth companies and technology and others like that, but you can't run a portfolio invested 100% on that basis. And if bonds don't look attractive, where does the money go? I think a good spot is the areas like these big dividend payers, especially ones that can grow the dividend a little bit. The valuations are there. And like they've just been out of favor because everybody's been chasing sort of high growth and the stuff that they really expecting to run in technology and else. And these things have suffered by neglect a little bit. To some degree, I mean, the energy sector is like that too. Some of these are good dividend paying. The pipelines fit in with that a little bit more. And I liken those things a little almost to the, the tobacco stocks of the 1980s and 90s. I mean, these companies were effectively ignored. They weren't growing anymore. They were obviously smoking was declining, so there was not much growth in the industry. And yet, you look at the Philip Morrises and all of that of those decades, they did exceptionally well. They generated a lot of cash. They paid a decent dividend. The dividends grew, and the stocks ended up doing very well. I see a lot of similarities, and certainly the energy sector today in that genre. I mean, you can get some decent dividend payers and at decent valuations.
Hmm. And John, I'm curious, did you step in at all into some of the REITs in Canada? I'm an optimist by nature, that is for sure. And so I actually stepped into Smart Centers as well as Automotive Properties REIT when I think I'm probably getting an almost a 9% yield. So I mean, I was buying when, during this pandemic when it was obviously so out of favor in terms of the reopening trade. Now they've been catching a nice bid. Did you step into any of those areas?
Yeah, we got into a few of them, not in the same areas there. I actually stepped into some of the nursing homes and the healthcare, Chartwell, Sienna, because last year they just got absolutely decimated. They were kicking out at 8 to 10% yields and trading at decent valuations as well. So there's a few names like that. Again, I've reduced the positions a little bit more. But I think you're right. The REITs, there are areas that are still going to generate cash. I mean, you talk about smart centers. Yeah, absolutely. I mean, obviously, the big box mall is big box retailers are still going to do well in this environment, probably better than some of the other malls. The risks are the office REITs. I think because I think office space is suffering a contraction that I don't think necessarily is going to recover in a hurry. So I think you have to be a little bit more careful there. So again, just you have to get the right name, so it's not an overall just invested REIT. But there's some things to kick out as decent valuation, and you get some yield. Again, you get some yield at the same time, which is something you want to get off the portfolio. You get a portfolio even if it stands still, and you don't do any. You buy an Enbridge right now or something. If the stock doesn't go up or down, you're going to kick out a 7% dividend yield, which is a lot better than you're going to do in cash or certainly the bonds or anything else. It's not the worst. If that's your worst case scenario or sort of a bad case, that's not so bad, and it gives you a little bit of downside protection too, as long as they're not cutting dividends.
Yeah, absolutely. And it is always interesting to take a look at some of those, really just stable dividend payers. They're they might be boring, or as we still say on Wall Street, look at, just because it's not sexy doesn't mean it's not a great stock to own. Yeah. So I had friends whose grandmothers, lived on their Philip Morris dividends.
Oh yeah, no, it's that's the investing world in general. Like you can sort of be part of the Reddit crowd or something like that and try to chase these the hot names, and when it works, great. But in the end, valuations do matter, Catherine. We've sort of seen it. Things get caught up in sort of also, and we talked about the pot stocks earlier, things like that. They get caught up in sort of a rage of enthusiasm. But in the end, fundamentals are what's going to drive these companies. And in the end, effectively, you're buying a stock, you're buying a piece of a business. And you have to be, as a business, would you buy that business at that price? And if the answer is no, then I think you got to question a little as to why you're buying that stock. And if you're not getting any sort of yield or other return on it, the growth going to justify that valuation at some point down the road. It has to be able to, even in a low or zero interest rate environment.
Mm-hmm. And so that brings us to, what would you be selling here?
Well, you know what, I would not be playing any what I call them the meme stocks. The Robinhood stocks. The whatever you want to call it. GameStop. I mean, yes, it what trading $180, $200 today. Hey, it did go up to $500 at a point. In my mind, what's it worth? Maybe $20, $30 or something like that. I just wouldn't be chasing those kinds of names. I talked about getting out of BlackBerry recently because it just it's come off more than 50% now from the peak that it got to. those things can turn down in a hurry. And I think there's lots of areas of the market right now that to me have that same sort of vibe. They've lived on this bullish view going forward of zero interest rates, and they squeeze some shorts out and they're taking the valuations. But AMC theaters, others like that, they were part of, like I say, these Robin Hood trades where I think they effectively went out and tried to find out what's the most shorted stock, and use the power of the internet, which was an interesting way to do it. And the whole thing of the individual investor didn't have much power before because nobody could assimilate them in a large way. And Robinhood and the Reddit sort of turned that around. If you can get them all moving in the same direction at the same time, they're a pretty powerful force. And it just squeezed the life out of some of the short positions. But that's not an ongoing thing. And if anyone got caught up in that, I would sort of, if you're down on it, I would just take the money and run, whether you've made money or lost money on it. Because I just, ultimately, I don't see the valuation supporting a lot of those names right now.
Mm-hmm. And John, just to pick up on the Reddit investor, the retail Robinhood investor, over the past couple of days, there's almost been a bit of a question mark in terms of if their interest is subsiding a little bit in the market, and therefore, that money flow won't necessarily be there to continue to move the market higher. I mean, people have to understand that it's always been the institutions really that have moved markets, but the Reddit investor maybe changed that dynamic a little bit. So if that money flow is not there, do you think about that? And the other question, though, is because of the power, to your point, about the individual investor being able to come together with ideas on the internet, causing a short squeeze in some of these names, like a GameStop. Is that one of the reasons why I heard you earlier say, you're kind of careful on the shorts? Do you think that more hedge funds are going to be, my goodness, a little bit more careful in terms of shorting stocks because of that? And if that's the case, doesn't that almost give itself or lend itself to being, there's going to be more of a natural bid higher to the market? I'm not saying this is good or bad. I'm just saying these are dynamics of money flows that you have to think about.
Yeah, no, there's a lot there to unpack, Catherine. But in terms of the latter points on the hedge funds and short positions, yeah, absolutely. I mean, I wouldn't short individual stocks in here right now. It is too dangerous, just especially if they're heavily shorted names, because we saw, and there were a few hedge funds that blew up on that. Massive hedge funds that needed bailouts because they reversed positions, even if they went to valuations that are unsustainably high. You can't get in the way of that. So in the hedge fund that I run, which is like a long short fund, the only thing I would short is indices, like the S&P 500 or the Russell 2000 or the triple Qs or something like that. So I'm long maybe value or a particular area, then I get short these things to protect it a little bit in case of the downturn. So, but yeah, I think you might see a squeeze overall in the hedge fund industry because of that. But on the individual investor side, that is a different story. It was interesting. I was paying attention to see these last stimulus checks that came out. Did that sort of go back and you get a little run on the market on that basis or not? But I think the issue there is last year when the stimulus checks came out, people didn't have too much else they could do. I mean, they were sort of locked at home. Every businesses were closed down. They couldn't travel. So there was nothing really to do with the checks besides invest in the market. And there wasn't even sporting events, so they couldn't bet on sports and other things like that. I think this time around, things are starting to open up a little bit more. And I think you got to believe going forward that that'll continue. So, maybe they can start to take a vacation again or spend elsewhere or go to a ball game or go to a restaurant or whatever. And I think they'll do that necessarily as opposed to necessarily sort of putting the money into the stock market. So I think it was a bit of a one-time occurrence. You won't necessarily see the same thing. I think the individual player has consolidated and they use the internet to their advantage, and then good, that's great. I mean, the individual investor lots of times got the short end of the stick. But so much of that has changed. I mean, that's Catherine. That change started back with Reg Q years ago, where suddenly the institutions like us used to have such an advantage because managers would come and visit you before earnings came out, and you get the wink, wink, nod, nod, and things like that. We don't have that advantage anymore. Everybody gets on the same conference calls and webcasts and all of that. You get all the information at the same time. That's good. You want a level playing field for everybody, and then that's better for the industry overall. And I think that's a trend that's not going to change.
Mm-hmm. And it's doing your homework with the information that everybody has access to.
Yeah.
John, you also though say that you would be selling SPACs. Interesting to note today that WeWork announced they're going to be going public through a SPAC. What do you tell people who are trying to understand what a SPAC is? And by the way, I used to sell them on the institutional desk when I was at Deutsche Bank, when they kind of first came out, these blank check companies or special purpose acquisition companies. They've gone through a massive change, and they are more popular now than they ever were. What do we need to know about them?
Well, I think you need to know where they're going to be ultimately investing in. But the problem I had with them is you price a SPAC at $10, they ultimately be priced at 10, and it starts to immediately trade 11, 12, 13, $14 because they're going to invest it in space, or they're going to invest in electric vehicles or whatever. And I thought, yeah, companies, I give you $100. It's not, what's it worth? It's worth $100. I mean, maybe you'll spend it in proper place and increase the investment and all of that. Why should anybody pay that amount for it today before they even know what's invested in? And the SPACs, yeah, if they don't spend the money at some point, they'll give you back that $100, 3 years from now or something like that. But in the meantime, why should it get a premium? That sort of reminds me of sort of the late 90s with the tech stocks and all of that, where you used to sort of have multiples of, a company would say they're going to put $1 billion of fiber in the ground, and suddenly it's has a market valuation of $2 billion. Oh, well, why? I mean, you haven't even put the fiber in the ground yet. So valuing something at a huge premium to what it actually is today just doesn't make a lot of sense to me. Buying growth is a different story, but that's the SPACs have sort of typified that. Really. Now, having said that, I noticed SPAC valuations have collapsed a lot or come back a lot just in the past few weeks alone, since that sort of downturn in late February. So I think you're already starting to take some of the froth out of that sector. So.
I guess people, though, when they give them a premium, they're just betting on that company management making and having access to some great idea and some great company.
Exactly. They sort of assume, hey, I think they're going to take this money and invest it, and it's going to go up, 20 or 30% or whatever. But like I say, I'd sort of like to see, my point of view as skeptic, I'd rather see what are you buying, let me evaluate that. Maybe make wanting too much control in this, but the idea that you suddenly value that today at that higher level seems to be a little bit premature and risky.
All right. John, I'm going to throw in the one last question. It's my question. Did you buy or have you bought into the digital asset space, cryptocurrencies, any of the funds that are now available? Full disclosure is what I'm trying to do here. And that's why I bring up stocks I own. I did buy that QBTC fund, the closed-end fund by 3iQ. So are you putting any of that in your clients' portfolios or institutional portfolios?
No, I haven't, Catherine. Not at this point. I may pay a lot of attention to it. I mean, crypto is a whole different world we get to open up. And I had to understand why blockchain technology is important and why it works. And obviously the energy consumption is a whole different story there to talk about. But the idea that you're using Bitcoin generally or any other crypto on a more sort of broader basis, I just think needs a little bit more support from either financial institutions or sort of other, major retailers, something like that to give it more of a background. But the believers in this really believe it, and valuations, yeah, they're excessive right now. I've never been a good momentum player, so no, I'm not there right now. I wouldn't even profess to, fully understand what the valuation should be. I don't necessarily see it as a store of value, but some people can see it. I see the need for digital currency and the logic of digital currency. And but you've got to have some safeguards behind it. Would you go out and make a large purchase using a cryptocurrency when you didn't know for sure, who was behind it or your ability to sort of recover costs, or even the volatility of the store of value? I mean, if you're going to buy something, you want to buy an item for a big purchase of $10,000, are you going to use a crypto that suddenly might be worth 20% less in 2 days when you go to purchase this item, which is still priced the same way? So yeah, it's just like I say, there's enough balls in the air and risk right now that I'm okay with that one. Will have to just pass me by.
Yeah, I hear you. I think sometimes, when we invest, you kind of just have to know what you really know and can focus on and what you're good at,
Yeah,
for the
and that was
majority of
sort
your
of,
portfolio.
Warren Buffett for years, maybe sort of extreme too far. He didn't invest in technology because he didn't really understand it. Well, I mean, maybe that's taking it too far. He stuck to his Coca-Colas and McDonald's and things like that. But at a point, yeah, I mean, you got to try to understand and learn about it. But I think cryptos is a bit more of a quantum leap into something that's totally different and doesn't fully exist right now. It probably will at some point, but buying cryptos to me is a lot different than, even paying up for an Amazon or an Apple or something like that. I think you can understand the dynamics and the markets and the
Yeah.
valuations a little bit more. So.
Yeah. And John, just lastly here, we always talk about the, big macro picture, the global dynamics, obviously a lot of focus on the US markets and some, of course, on the Canadian markets as well that we've talked about today in terms of liking the pipelines as well as the banks. But I think a lot of our viewers probably are Canadians. So just to kind of step back and put everything in perspective, you're comfortable with the Canadian market, the economy, the outlook, it sounds like. So what kind of, if that's true, like what kind of weighting would you put towards Canada versus the United States?
Yeah, I think in our portfolios right now, we're, typical balanced portfolio with maybe, 65% stocks. I say right now, probably 50 of that is Canadian and maybe 15 US. Because it has more tilt towards Canada. When I look at it, I looked at a chart the other day, sort of the comparison, the S&P versus TX. Actually, you do those charts, and it moves in longer wave cycles, and it looks to me a little like it did back in 2000. And when you look at that period, you realize for the next 10 years, basically, the TSX outperformed the S&P 500. Just the valuations are more attractive here in so many industries. We don't necessarily have the technology overweight here. That distorts it a little bit. There are, like I said, the areas like the telecom, the pipelines, energy, industrial, the financials have underperformed. I think we'll play some catch up. I think it all plays pretty well to where we are. It's funny, the currencies seem to be acting a little bit better too. Maybe it's telling you a little bit that our obviously fiscal position is stretched like everybody else, but certainly not stretched any worse. So I think we're in pretty good position here, and I think we've underperformed for a number of years. So there's some catch up. So I think the idea, money has been migrating out of Canada for a number of years. Institutions have pulled out, major funds have pulled out of the fossil fuels and all of that. A bit of a dearth of capital. And I think there is a sort of this shortage of capital. That's opportunities. And I think for investors, I think you're going to need opportunities in a lot of these names right now. So to me, it makes sense to, have some Canadian exposure for sure.
Okay. John, we will leave it there. It was great seeing you and speaking with you and getting your thoughts again. So thank you so much.
Thanks, Catherine. It's always a pleasure.
Thank you.